Welcome back, guys, to another Market Radar podcast. And this week, we're going to talk about the path of the Federal Reserve. We're going to go over details on what happened in the market this week and what we expect to happen in the market in the near future. So let's go over NASDAQ. What I have on my chart right here, I have two lines, an orange line and a white line. The orange line and white line are the NASDAQ and NASDAQ equal weight. And you can see there's quite a divergence going on right now between the two. We have the NASDAQ up 29% year to date, with the NASDAQ equal weight only up 15.5%. This is telling you that there's a concentration within the holdings because it's market cap weighted, it's not equal weighted. And those companies that are market cap weighted are obviously outperforming the vast majority of other companies in the basket, which is why the NASDAQ as a whole is outperforming the equal weight. This is something that a lot of people are picking up on, a lot of people are talking about it. But all it generally means is there's a concentration in certain assets, and that will most likely continue as long as the trend remains bullish. Remember, the NASDAQ has been bullish DDAP trend at Market Radar since March 21st, 2023. So it has been almost we're going almost into the third month here where NASDAQ has been bullish trends. So shorting bullish trends is not something that we do. We don't advise against it. We don't advise you do it. And it's just a bad all-around decision to do that because markets can go up longer and more linear than you could possibly imagine.
So what does it mean seeing this divergence between the equal weight and the NASDAQ?
So what it means is we're seeing a higher concentration in the market cap weighted assets that are in the NASDAQ. So for example, look at NVIDIA, right? NVIDIA, obviously we had the blowout week with the earnings, with it up over 20% on the earnings release. All these any of these NASDAQ companies that have AI associations with them have been moving, like Google, Microsoft. All of these aren't equally weighted throughout the whole index. So if they're moving more than any of the other constituents in the index, the market cap index is going to be able to outpace the equal weight index because in the equal weight index, everything's weighted pretty much the same.
Right.
So,
but so does that kind of make the NASDAQ a bit more fragile? And I see a lot of people shorting the NASDAQ, getting absolutely destroyed right now because they're using that as a reason to short. Is it's a lot more fragile since there's only a few companies that are really propping it up. Is that a good idea to do?
No, because I'd make the counter argument that the NASDAQ is actually stronger that way. Now you might say like, what? How does that make any sense? Well, if you have more money, so remember, markets are a repetitive cycle, right? Meaning, if Nvidia gaps up 20% and holds it, you have serious risk of Nvidia going, call it 20% higher than where it just gapped up from, or gapped up to, excuse me, right? Because if Nvidia doesn't sell off, well, you just showed everyone you can gap up 20% and it's unfazed. So everyone's going to look for the next 20%. And that's how bubbles are formed, right? Think about it. Bubbles are not generic. Bubbles don't occur in just a generic blanket. Now, we do have overpriced asset waves, right, in the market, but in terms of like actual bubbles, like the Bitcoin bubble, anything that was associated with Bitcoin up, right? .com bubble, any tech company just up huge, right? Anything was explosive. And even the weed bubble back in 2015, right? Any marijuana company, just any company that dealt in the marijuana space up huge, right? And that's because when you have something in a specific sector that's moving, like Nvidia, right? All eyes are on that company, and all eyes are saying it's up 20%, like on the earnings. How many people got wrecked trying to short that from Thursday to Friday when Nvidia was up another 3% following that 30%, 20-something% gap up? That's what happens. The market, everyone starts looking at those companies and the immediate reaction is to bet against it. Then when it fails, it's like, oh my God, this can actually run. Like when Bitcoin went from 10,000 to 20,000 in 2021, right? Everyone was like, oh, this is the top, this is the top, this is the top. Then Bitcoin went to 69,000. The same type of concept applies. If you can't kill a stock fast enough in the move, it becomes there becomes more and more concentration risk, and then it becomes a bubble. We are not near an AI bubble yet, though. Just because Nvidia is up 25% doesn't mean we're in an AI bubble. If you look at the actual landscape of where AI, the general automation, robotic ETFs, and just the basket of the mass majority of companies, we're not in a bubble yet. But what this type of divergence that you're seeing here in the Nasdaq, what it's doing is you're slowly starting to put pieces in place for people to start, like you just said, short it because it's fragile. And guess what? This week, NASDAQ was up 367 basis points, right? 367 basis points in 1 week. I'm sure we closed the week with a bunch of people trying to short this. Well, what happens next week if we're up 200 basis points? More people will try and short it. But every time you do a move like this, it has a compounding effect, because what this is showing is it's showing everyone that the market is stronger than everyone thinks. Even though it's only a basket of few companies, it doesn't matter at the end of the day. Yeah, you can claim breadth is weakening, it's stretching. I understand, but bubbles do not occur with strong breadth, overall breadth. Bubbles are when they come into play. Even if this turns into a bubble, I don't know how big it would be. We can't really time bubbles, but they can be small, they can be medium, they can be large. But bubbles do not occur with generic market movements in the same direction. They are really specific, specifically in tech. Like, these tech bubbles are very specific in terms of if it's going to be AI, or if it was
like 3D printing. We have that
exactly,
as well.
right? Like, it's so precise. So when you look at, like, when you take the approach of saying that markets can't go higher because the breadth is thinning and, like, there's not enough momentum across the whole index to support it higher, well, that's not the case. Like, that's not how the market moves, which is why I'll always lean back on the fact that the Nasdaq's bullish trend. You don't short bullish trends. Keep it simple, right? Like, you don't go outright short a bullish trend, because there's no point in doing it, because bullish trends tend to lead to higher prices. So your odds are stacked against you.
It's equivalent to catching a falling knife. It's
on the reverse way. Yeah,
just the other way around.
Yeah, pretty much. But then let's move over to bonds. What happened in bonds this week? Bonds closed the week down 93 basis points, and they've been pretty much hammered in almost a straight line since the April CPI that was released earlier this month in May. And long bonds were unable to break Momo. They couldn't get and hold above, I should say, and they faded from there. A lot of people got long bonds in this area because of this whole idea the Fed would pause. And that's just not what the market is saying is going to happen right now. And they also got stuck with this whole debt ceiling debacle, where there is a probability we could have a credit downgrade. Not that we would see one, and not that the market's really so concerned at the moment we're going to see one, but you can just tell if you look at the shorter term bills. I'm talking 1 month. They're trading at almost 550 basis points as of the close, and as of the close on Friday. And the expected Fed funds rate in the next month is maybe 525 basis points. So the 1 month bills are pricing in a possibility of, most people will look at that and say, oh, the Fed's going to hike 50 basis points. That's not what's going on here. What's going on here is there's no demand for that issuance, because there is suspicion that there could be some hiccup getting the payment with that issuance due to the debt ceiling debacle that's expected to take place here. That's still taking place and expected to continue for the next week or two here. Obviously, longer if there is no resolution, but I do believe there's going to be a resolution. And because of that, bonds have sold off. In terms of, and this is not inflation related. This decline in bonds is not inflation related. Doesn't mean it's not Fed related, but it's not inflation related. And that's really more important when you look at the bond market. The Fed plays a major role in the bond market, but the longer you got in duration, the less the less of control the Fed has over that issuance, or that tenure, because the Fed cannot. The market, as you go out in duration, the Fed has less control, because the Fed policy really controls the front end of the curve, because they are really the benchmark for short-term interest rates, right? So
Right.
they have no control now. Japan, on the other hand, is a country that does yield curve control, and that's not what we do in America. So the Fed, if the Fed were to do something like that, they'd gain more control, but it's very limited because then the Fed would have to basically be in a mode of unlimited QE, which again we are not there. We are on the opposite path. We're going down the road of QT at the moment. So
Well, so
um,
what would a debt ceiling resolution do to bonds? Is it going to completely
just,
reverse course and head back up to Momo if that were to happen?
I think a debt ceiling resolution would be bullish for bonds. I also think it may be slightly bearish for gold. And my reasoning is gold has held up rather well the past few months here, right? Like gold's still bullish trend. It's actually perking up here after coming down right on Momo, quite interestingly. But it's bullish trend and it's been grinding higher. And this again, typically we don't see this bond and this bond and gold outperformance like we've seen in the last year. Number one was due to there's been a premium on gold worldwide. If it's the war, whatever it may be, that was going on in Europe. But now we're seeing this premium, I believe, in gold, and that premium being there's no default risk holding this, right? You have there's no government debt ceiling that has to be raised for this to work. This is just gold. Gold is gold. Whereas bonds, you have this other mechanic that is going to affect the price. Whereas inflation will affect both gold and bonds, but the Fed will do more damage, or I should say, the U.S. government can do more damage to bonds than they can to gold. And I think that's why you're seeing this gold pretty much sell down, right? Gold is, I mean, excuse me, bonds are almost back to their March lows, right? We're getting down there. Whereas gold's March lows are, oh, I take that back. Gold's, excuse me, gold is above gold is way above the March lows, right? The early March lows. Whereas bonds are much closer to those March lows. And that's because, again, I think that there's this discount that's being placed on bonds right now, and that's primarily due to this whole debt ceiling situation. So if we get that relief from the debt ceiling, I think bonds can rally. But the key here for the bond trade to really ignite is going to be the direction of growth. We're going to need to see a growth slowdown in the market. Now, it doesn't have to be major, but it has to be enough to entice the bond market to believe that interest rates will come down overall from the Fed. In turn, which will boost the bottom line for long bonds. Not by much, though, because the bond market, again, on the long end isn't as controlled by the Fed as it is on the short end. But let's go over what's going to happen next week in the markets.
Yeah, so next week we've got consumer confidence on Tuesday. Oh, Monday, market is closed. Don't forget about that. Thursday, we've got jobless claims, and Friday, we've got jobs numbers. So Friday is going to be a pretty big day. Really interesting to see how that's playing out. Let's talk about the PCE that came out today. So seeing a lot of talk on Twitter of Fed has to raise rates even more now. Inflation's not over. It's kind of ridiculous that people have that mentality from this PCE print. We specifically said once you get inflation CPI down to around 5%, you're going to have some hiccups. It's a lot easier to get from 10% to 5% CPI than it is to get from 5% to 2%. It's not going to go down in a straight line. You're going to see some inflation metrics like this, like PCE, bouncing a little bit. It's to be expected. And really those people that are calling for, inflation's not over yet, Fed needs to hike more, it's all just fear mongering.
Right, and I want to clarify that's the note for that Artie just mentioned about CPI, right? So it's easier to get CPI from 10 to 5 than it is from 5 to 2. That's the same for PCE, right? PCE prices and anything in related to slowing prices down. Since inherently everyone knows that there's going to be this relief around the 2%, like meaning CPI, right? The reason why it goes down faster is because everyone's against it at 10% down to 5, but once it starts dropping under 5 and going down towards 4, 3, 2, everyone's like, oh my God, did we do too much? And then the easing comes in, right? Like, so there's like this floor at 2% because we know the Fed's long-term inflation target's 2%. So anything below 2% is going to automatically get the the type of viewpoint that the Fed needs to really reverse course immediately. So there's that hard floor that really that is what slows everything down, because now everyone's going to be concerned, is the Fed going to start reducing the spigot, or reducing the fight as we go under 5%, going close as inflation goes closer to 4 and then maybe 3.5. The Fed's going to have to slow down, because where policy is right now may be too restrictive, or most likely would be too restrictive for inflation in that sub 5%.
But we're really not
sub
even
4%
seeing
zone.
anyone expecting that right now. Everyone's still calling for inflation, it seems like. It seems like everyone's become a perma-inflationist lately.
Yeah, it's funny how that works, right? Because everyone goes, you had the crowd say inflation was transitory. Those chads were mocked, right? And I guess they were not really those simps, right? They weren't chads because they were calling for transitory inflation in early 2021, before inflation even had its run. So they got smoked, right? Those same transitory inflation, transitory individuals, they then kept claiming transitory along the way. You had these deflationists flip towards inflation, right? Because from a deflationist to inflationist, because they're like, oh yeah, deflation is not coming; it's all inflation. And now you have the situation where the transitory guys are still there cheering inflation's peaked, this whole nine, and now you have the deflationists thinking that inflation is going to rebound. So you had both parties get both sides of the trade wrong, which is astounding, right? You had the bulls and the bulls and bears of inflation get each side of the trade wrong, surprisingly. And that's how markets work, because what ends up happening is, as inflation was going up, all the people that what you have to understand about inflation is, by default, it's transitory, because we have a Federal Reserve that is going to step in and prevent it from running away from us.
Right. And
Right?
right now we're in a situation where deflation is slowly becoming the most likely outcome. And you can pull up the 5-year break even. That's exactly what it's showing. So people are seeing these PCE numbers come out saying, oh, inflation's still an issue and all that. If that were the case, why are 5-year break evens not ripping higher if inflation
Right.
really was an issue?
Right. And for those that don't know, this is basically measuring the expected inflation rate on average over the next 5 years, not the past. This is forward looking. So this is the next 5 years. Now, what I will note is we're stuck at this 2.12, around this 2.1% range. We've been here since October, right? We've been chopping in this range. We're slowly grinding lower. It looks like it wants to break down and really go down. But we haven't broken this 2.1% mark yet. And what this is telling you is that the bond market thinks that inflation in the next 5 years is going to stick around 2%. Now, ideally, this is 5 years from today, right? So ideally, we see this under 2% to really get the Fed on the same page in terms of where they think policy is going to go, to really slow down the rate hikes and potentially start rate cuts. Without this under 2%, the Fed will not do any rate cuts, in my opinion, because you can look back historically. This has spent very little time above 2%. In 2004, 2005, it was between 2 to 2.5%. Rates were higher then overall, and obviously inflation was higher as well. But in terms of recent times, this doesn't stay above 2% for very long, and the Fed really wants this down towards that sub 2% to at or below 2%. So the Fed still thinks that they have some work to do. Now, let's talk about the Fed quickly here. So this is our Fed funds forecaster, and what this does is it measures the expected number or direction of Fed moves in terms of policy actions in the federal funds futures. These are not bonds. Okay, the federal funds futures and the bond market are two different things. So when someone says, "Oh, the 3-month is trading at 5 and call it 5 and right here, the 3-month is trading at 5.317. This is pricing in X amount of rate hikes. No, that's not what the Fed fund forecast uses. There are specific contracts that delegate only or only deal with, I should say, Fed policy expectations. So there's no bond market manipulation there. Now, bond price moves can affect the Fed fund futures, but they are not tied in that manner. They're their own security. So, in the past week, the odds of a June hike have jumped from a probability of 17% to 71%. So, as we've said, as long as it's above 50%, it's something we have to consider. Now, we've been very vocal about our thoughts on the Fed likely pausing. Okay, so pausing rates, but unlike the rest of FinTwit, we did not chase bonds when the idea of the pause emerged. So we're still in a very good position to make a move depending on what happens. We're not sitting here drawn down in bonds wondering, oh my God, I hope the Fed doesn't hike. The Fed does hike, it wouldn't be what I expect they would do, but right now I do expect them to hike given where the Fed funds futures are. A week ago I didn't expect them to hike, but again, it's not going to hurt my positioning because Aries has sidestepped all this noise, and once Aries strikes, most likely a lot of this noise will be behind us. But the big caveat here with this Fed policy repricing in the past week, so going from almost no probability of a hike to a 71% chance of hiking, is the Fed forward futures are implying rates get hiked. Okay. They're going to get hiked and then they're going to get cut equally by the end of the year. So by the time we get to December, the December price on the Fed funds futures is just about where we are right now, meaning they expect a no change by December at this point in time. So one of two things need to happen here. Either the back end gets lifted even more, meaning the back end is so wrong that the Fed is going to actually not be at 5% by the end of the year. The Fed's going to be sitting at 5.25 or maybe even 5.5, right? The idea that the Fed is going to hike and then cut by one one rate hike within 6 months doesn't make sense.
Right. Like when they cut, they're going to cut. They're not just going to cut once, right? They're going to cut because they need to stimulate the economy because deflation is hitting.
Right, yeah, exactly. And like you have to look at it from the Fed. The Fed is the best way you can describe the Fed to somebody is imagine trying to hang a picture in your house and you have, a nail the size of your pinky, but you decide to use a sledgehammer. That is the Fed. That's how they operate. Because their policy tools are blunt. They like to make you think they have all these tools. They're so precise. Again, another analogy, imagine a surgeon using a chainsaw. That's literally the Fed. If it comes to easing, they cut the zero, open the spigot, QE to the max. They don't care, right?
Yeah. They don't half-ass it.
Right. They don't half-ass it. They don't let a good crisis go to waste. So in terms of them cutting, now we have seen in the past where the Fed does reduce rates incrementally, call it 25 basis points at a time. Specifically in 2018, I believe it was 25 basis points at a time for a while. And then we had the COVID pandemic and everything just went to zero. But pay attention here to where the rates are expected by the end of the year. If this is going to be a material rate hike, meaning we're going to actually see it materialize, I don't think we're going to see a rate cut this year. I don't think the Fed is cutting rates this year. So if we see a rate hike, the back end's going to have to go up even more. Meaning if we are facing a 71% chance right now, I would almost bet that the end of the year, or I would bet that the end of the year is mispriced because I don't see why the Fed would cut by December. But we also have to take into consideration that the FOMC meeting is June 14th. And remember, next Friday, we have NFPs, so non-farm payrolls. And I think we'll need to see how that plays out. And I wouldn't be shocked to see this rate hike get priced out of the market for whatever reason. Even if the jobs report is, call it hawkish, maybe the market's pricing that in now and, pricing in, or basically price the rumor and sell the news type of thing. I don't know if we're going to get a rate hike. I have this feeling that if we do, like I said, we're going to see this misprice. This is going to be a misprice out here. The whole back end is going to really lift. Um, I again, I'm going to have to take. I have to use what as we tell you guys. If it's above 50%, the odds are there. So the Fed's going to hike at the next meeting as of right now. But do I think that these odds will stay the same by next Friday? I don't think so. But we're going to check back in next week. We'll cover that and we'll see what the market thinks the Fed's going to do next. Thank you guys so much for listening and have a great week.